So good afternoon, ladies and gentlemen. My name is Martin Garratt and I'm Chief Exec at Cambridge Cleantech. Delighted to see so many people joining us on this event, which have become the norm for now. But of course, what we're looking at this afternoon is the Clean Growth Fund, and also related to what I've just been saying, post-pandemic growth. How can we grow back better, as has been said by some of our senior politicians? I mean, certainly, if you take your mind back to 18 months ago, before the lockdowns and the impact of the pandemic, cleantech and sustainability were right at the top of the agenda. So we had Greta coming over from Scandinavia and then getting a sailing ship to the UN in New York, had forest fires in Australia and in California, where people sticking themselves to tube trains in London. Do you remember all of this? Then we had the pandemic and the impact of that. But as we've, hopefully started to come out of it, we've begun to see that the UK has its 10-point green industrial revolution. Europe has its green strategy for emerging, the Green Deal for emerging from the pandemic. And we've had a lot of contact from corporates who are very interested in how to be cleaner, greener and more sustainable. So we think it's all going back in the right direction again. And of course, access to finance is all part of the requirement to enable SMEs and innovators to grow in particular. So that's just a bit of context for you. I'm going to say a few words about housekeeping in a second, but just suffice to say as well that obviously at Cambridge Cleantech we're very keen to support companies. Our latest newsletter just went out yesterday to our database of over 3,000 companies in the Cambridge region and another 2,000 in the Oxford region. And that had opportunities detailed in it, such as Carbon 13, the accelerator in Cambridge at the Judge is recruiting or looking for applicants now for its next cohort of SMEs in the cleantech sector to go through its accelerator program. The closing date for that is the 19th of July. Take a look at our website if you want more information. There's Tech Nation are doing a similar support program with a closing date a little bit earlier in July as well. All of this information's in the newsletter. And just a couple of future dates for you. Our next event looking at climate impact and SDG 12 is on the 8th of July. Do book for that if you're available. That's another event. And then an early warning, an early save the date is for our 10-year impact. We're actually 10 years old this year. So in October, on the 20th of October, we're doing a 10-year impact look back and then look forward to the future, what we'll be doing next as Cambridge Cleantech. And that's followed by a Cleantech Venture Day, a pre-COP 26 Cleantech Venture Day on the 21st of October. Both of those are will be events as well. They'll be digital events. But the application process for those wishing to pitch for funding to a room full of cleantech investors will be open very soon. And we'll pick the 24 or so of the most investment-ready companies to pitch on that day on the 21st of October, just before COP in Glasgow. So a bit of background on Cambridge Cleantech. Some housekeeping I've just got to run through with you. We are recording this session, just so that you know, and this will be available after the event tomorrow morning. Please do remain muted whilst the conversations are taking place. If you have a question, do by all means enter it into the chat box and we'll pick that up. If it's a pressing question, we'll do it as the presenter finishes, or if not, we can take them at the end in the Q&A session. And we have Orianne with us, who's I think already sort of introduced herself, and Sylvie from the Cambridge Cleantech team to help with anybody who needs help and support during the day. They'll issue messages in the chat box just to help people as well. So anyway, that's enough from me. You've not come along today to listen to me, just a bit of context and a bit of background. Let's get on and first of all have a look at the new Clean Growth Fund in terms of the opportunities and the theory behind this and what the criteria might be, and looking at some case studies as well. I'm delighted to say that we've got one of our latest founder members, Bev Gower-Jones, who's the founder and managing partner at the Clean Growth Fund, and she's also founder and chief executive of Carbon Limiting Technologies, and we've worked with Bev for some time. So delighted that she's one of our founder members now and that she's taking this fund forward. And over to you, Bev, to tell the attendees a little bit more about it. Thank you.
Thank you very much. Martin. Let me see if I can screen share. Can you see that?
Yeah.
The slide, can you see the slide? Or
Yeah, we can see them.
Okay, good. That's a good start then, isn't it? Let's start then with return on capital, which is one of the two Clean Growth Fund key objectives. So good place to start. From this slide, I think you can see examples of 6 clean tech companies that have exited between 2.5 and 6.8 times money multiple. At the Clean Growth Fund, we think this is because corporates are actually looking to reinvent their products and services, and these are capabilities that they need to own and to scale as they embrace the energy transition, that they're not just acquisitions for incremental market share. So corporates appear willing to be able to buy ventures before growth and later stage private equity get a chance to invest, which dispels the perception that superior returns can't be achieved for the early stage investor. And also provides clean tech entrepreneurs with that solid evidence that they need that profitable exits are achievable. So if we just take a couple of examples here, you can see that Lion Jump focuses on providing balancing solutions to the power grid through battery management and aggregation of flexible load. And they raised their first VC round in 2015, total funding of 9 million. And exited to Shell 4 years later for an approximate 50 million valuation at a multiple of 5.6. Similarly, Chargemaster, which is a vertically integrated electric vehicle manufacturer, raised a total of 19 million in 2014 and sold to BP for 130 million, which is 6.8 times multiple. And Shell, of course, acquired Sonnen, which is a domestic battery system, and intelligent storage and linking solar to the roof automatically, so thereby adjusting energy use in the house to ensure it's supplied with clean energy so the homeowners are independent and protected from price hikes. And so that multiple was about 2.5 times within 6 years from first funding to exit. All very impressive, and these are more achieved between 2.5 and 6.8 times return inside of 5 years. The other key Clean Growth Fund objective is to invest in promising SMEs that deliver a significant material impact on reducing greenhouse gas emissions or increasing resource efficiency. What we look for here is asking each of our potential investee companies to be able to describe the estimated carbon or greenhouse gas emission reduction that they're able to save per widget or per unit of their innovation. And then we look at what the cost per tonne is. We ask them to estimate what the cost per tonne of that saving would be. And then by forecasting and looking at the sales growth and the potential, we can create estimate over time. And that's taken into account in investment committee decision making, in terms of kind of whether that saving is significant, and that's then monitored annually using a baseline survey. So at the macro level then, what's this opportunity all about? At the Clean Growth Fund, we see 3 major drivers to change that are creating demand for new solutions. So those 3 kind of drivers are here in the green circles. One, of course, is demand pull. So particularly since 2019, we've seen an ever-increasing customers demanding that products and services they buy reduce or mitigate their environmental impact. And that's becoming more and more clear. In terms of regulatory push, government and regulator encouraging or forcing the change to reduce carbon emissions or other environmental impacts and increase resource efficiency. In the UK, of course, we now have the Energy White Paper. And in the US, of course, Joe Biden has put Cleantech firmly back on the map, which are all excellent trends. And then the third, of course, is economic fundamentals. So the cost down curves that have been seen with lithium-ion batteries and solar and so on are encouraging business and consumer to reduce costs and risks by consuming less and reusing and recycling more. So, you know, this is all creating a world that's transitioning to be cleaner and carbon free. We see kind of 5 core sectors that each contribute roughly 20% greenhouse gas emissions that are transforming, and actually in that transformation it's innovation and technology that's on the front line. This in turn, of course, generates attractive investment opportunities because you know, where there is significant change, there is also commercial opportunity. And so, you know, in terms of those opportunities, then in power, where we see those opportunities, the first in power, increased use of renewables necessitates technologies to optimise and automate use and storage, as well as digital systems to respond and manage change on national distribution grids. The creation of additional approaches to more localised energy generation makes us less dependent on ageing infrastructure. Renewables, combined heat power, hydrogen and fuel cells also help complete the energy transition. As we kind of move to transport, and I guess one of the things I should say here is, of course, is that each of these market sectors are not silos anymore, but they're actually interconnected, and it's in that area and in that interconnection where we see also quite a lot of opportunity. But in terms of personal transport, the demand for lightweighting and new materials is enormous. Increasingly, cars will be shared, not owned, which will necessitate new business model structures. Not all transport can actually be electrified. So, for example, shipping will need alternative fuels, propulsion systems such as ammonia, fuel cells. And then, of course, drones and self-driving vehicles for delivery will bring advances in autonomy, sensors, software and artificial intelligence. In terms of waste, we need to seek ways to avoid using harmful or hydrocarbon-based raw materials in plastics and other goods. We need more thoughtful use of waste to produce valuable components when their use can't be avoided but could be more readily reclaimed. And increasing use of bio-derived sustainable fuels to enable old process to become clean. Upfront design of packaging and reinventing of logistics systems, such as empties to go back to the factory and not to landfill, you know, the circular economy, in other words. And then in terms of construction, it's clearly a modular construction using sustainable resources for new build and, you know, rather than carbon intensive brick and cement. And then retrofit of existing housing and commercial buildings to increase energy efficiency, both heating and cooling, particularly cooling. We've heard quite a lot of that from the Committee on Climate Change and the adaptation requirements, and then air quality improvement in urban and cities. And lastly then in industry, increased use of industrial biotechnology enables old processes to switch from fossil fuel derived to production of bio-based chemicals and products, using less heat and power, and capture and conversion of waste from industrial processes for community use, utilisation of new sensors and controls to increase proactive maintenance and energy efficiency. Now that's clearly a vast landscape to be looking through, and of course we can't go into each of those in detail today, but I will be taking a quick look at the top 2, power and transport, because that's where the Clean Growth Fund has made its first 2 investments. In terms of, you know, how do we kind of look and approach each of those different areas? At the fund, we research each of these areas to understand latest market trends, to understand what key players are doing, and we identify areas where we think innovation could have a big impact and where we see disruptive change occurring. And by this systematic review process enables us to proactively identify promising companies that need investment. And of course, these maps are being continually updated on an ongoing process. But this enables us to look at the system and the landscape overall, rather than looking at you know, each company on a kind of a one-by-one basis, if you like. So if in turn we turn to take a look at power then, the first step to a cleaner, greener world is to decarbonise the electricity grid. It might seem obvious, but there's no point driving an electric car if the electricity is generated by a coal-fired power station. The UK now has over 50% of its electricity from renewables, and we've learned that whilst the traditional generation system was one way, as shown in the picture here on the top, power was generated at the coal or gas-fired power station, fed through a transmission and distribution system to homes, businesses and factories. The grid of the future was a smart, two-way, more complex system requiring active network management at all levels. On the generational supply side, solar and wind are fed in at multiple points, and on the transmission, distribution and end user level on the network. On the demand side, the requirement for electricity is ever increasing as cars, space heating will move to electric, and given the intermittency, storage is essential. So to ensure resilience and stability, new services such as demand response, where the supplier asks, the demand side gets paid to turn down their requirements at peak times, is an absolute necessity. This added complexity and the need for new grid management services gives rise to a huge commercial opportunity. We see rise in entrepreneurs and ventures developing solutions to meet market need, though many ventures such as Grid Beyond, Evergreen, Line Jump, Upside have developed solutions to aggregate either single or multiple assets with or without storage, which can then be traded on auction platforms. These allow the aggregators to offer their assets for turn down to DSOs, distribution system operators. At the transmission level, ventures such as Electron, Kiwi, Pearlstone and Origami are fulfilling similar functions. Using its deep sector expertise combined with the landscape mapping that I spoke about earlier and our extensive network, the fund's delighted to have completed a Series A investment in PICLO. And James will be speaking after me to give you some insight of his own fundraising journey. So I don't pretend to know as much about PICLO as James does, clearly, but I will give you a brief introduction. James can tell me if I got this right afterwards. So PICLO is an auction house or trading platform for flexibility. In the summer of 2020, it completed the world's largest flexible trading auction, £14 million for UK power networks, and provides services to the majority of the UK distribution system operators. The EU directive, the Clean Energy Package, is now opening up across Europe and is following the UK model, and PICLO is uniquely positioned to seize this opportunity and expand its services into Europe. So we're looking for great things, James, no pressure. If we move a little bit and look at transport for a moment, globally the number of electric vehicles has been rising exponentially. We now have over 7 million on our roads, but this is a drop in the ocean when you look over the next 20 years at the forecast to 2030, where you can see the number almost rises to 250 million vehicles. For all of these vehicles, 80% of owners have to charge at home because it's 10 times cheaper than on the highway, where the utilisation rate is very low because they're only used if absolutely necessary. And so also the Clean Growth Fund led an investment in Indra, which is a smart charger manufacturer for home charging. Indra allows the homeowner to select via an app charging the vehicle when the electricity generation is at the lowest carbon intensity. All Indra chargers are connected to the grid, enabling the owner to benefit from the battery to provide grid flexibility services. The company is a global pioneer in vehicle-to-grid technology, having designed and built the hardware used in the world's largest BTG program.
It's another 2 minutes, please, Bev.
That's all right, I'm just finishing.
Oh, good.
I hope to provide some insights into where the Clean Growth Fund sees cleantech opportunities, and thank you for listening. I really look forward to further discussion in the roundtable session later, and I'm pleased to hand back over to Martin or James to provide the next presentation.
Okay, thank you very much indeed, Bev. There's very sort of clear indication of your priorities in terms of energy transformation and future transport. I suppose no surprises there, but good to hear it directly from the keeper of the purse, if I can call you that. So if you're the keeper of the purse, what about the person that's received the money from the purse? So over to James Johnston, who is the Chief Exec at PICLO, as Bev has just indicated with a bit of a resume. Over to you to give us a little bit more information, James.
Thank you. I will share my screen. It's not letting me share my screen for some reason. Maybe if the presentation I sent to Orion, you can pop up and I can talk you through it.
Yes, no problem.
So I have a couple of slides. I will talk you through very briefly PICLO, and I'll be very brief because Beverley has already introduced the company, and then I will focus most of my 5-minute slot on our fundraising journey so far. So if you go to the next slide, as Beverley has already introduced, the transition to net zero is putting all sorts of different stresses at all different parts of the energy system. Now, where we're focusing is on the distribution grid, which is where all the fun stuff is happening. That's where most of the low carbon technology is being connected. And the grid was never designed for all of this. And we need new ways of managing the network. If you go to the next slide. So the solution at a high level is flexibility. Now, what that means is where you have the ability to change when change or modify the consumption or generation patterns of an end device, so that you can keep the network within its operational limits. I guess think of the electricity network as a finite sized system, and if everyone's going to be charging their cars at the same time, you're going to breach that finite size. So the key is moving that around, and that's what flexibility is. And ultimately, it's a game where there is potentially millions of devices taking part at the edges of the grid. So it's a very complex system that we're talking about. If you go to the next slide. So where we come in is we make what this could be a very complex system into a very simple interface for the different participants. So first of all, we make visible the local congestion on the network. You can translate that into opportunities. These are revenue opportunities for flex providers. So we make those visible. We make the assets that the flex providers have visible to the grid companies. Fundamentally, we provide a digital procurement service. And that includes our auctions, which facilitates sort of making sure that the companies are delivering these contracts at the best value to ultimately the consumers who will be paying for this in their bills. And going forward, we've got a robust roadmap where we're integrating with some of the operational flows as well as developing secondary markets. Next slide. And as Beverley said, we've had a lot of exciting traction in the last couple of years so far. Over £47 million of contracts have been awarded, and this is growing every couple of months. So stay tuned to see how that grows. And as you can see, we're working with a wide cross section of the flex market. Now, if you go to the next slide, we'll stay on this slide for a bit. So today's discussion is all about investment. So I thought I would share our kind of whole story on this one slide, because actually the context is really important. Now, the company was founded in 2013. To enable myself to start the company, I took out a personal loan of £10,000 to essentially pay my own, to essentially not need to have a job for a while. And it's funny how that you can start from quite a small beginning to where we're at now and having raised a Series A. But the journey has not been simple. I think, as you can see at the different touch points here, the numbers kind of are growing as you go from left to right. What you can see is effectively a number of different types of investment that we've raised depending on the stage of the company. So early on, it was from Bethnal Green Ventures, which is an incubator program that was very important stage in our development. We didn't, as first-time founder, it was very important to get that sort of be part of a group and get that support mechanism. Following on from getting some grant funding in place, we then looked to raise our first angel investment round, which we did in 2015. the next period was a sort of a very interesting period where there was no sort of single large round. We actually did a number of small closes. The smallest close would be like £25,000. I've heard the phrase salami slicing being used to define this type of fundraising. It's not, I wouldn't describe this as the plan A at that period. It wasn't definitely to sort of raise small amounts of funding, but that's effectively how the situation panned out. And we raised a fair amount through a number of smaller closes, just over 700,000, focused on individual private investors. The sort of first sort of institutional or semi-institutional group was then when we had investment from Green Angel Syndicate in 2018. And that was a step up from working with individual private investors, because they kind of came as a group and did more in-depth due diligence. And then finally, the Series A that we just closed earlier this year, led by Clean Growth Fund, with participation from Mott MacDonald and also the Future Fund, as well as a bunch of our existing investors. Now, three things I want to sort of highlight about this overall journey. First of all, fundraising is really difficult. It takes up a lot of time. There was a lot of false starts in our 8 years. We tried to raise a Series A back in 2014, which wasn't a good idea, because the company pivoted around about 2016, 2017. So we didn't have the right model in the early years, and that was picked up by the capital markets, and we weren't successful, and therefore that's why we went down the angel routes for that period of time. Even in our successful Series A, there was a lot of investors we spoke to. Generally, if they were investing in this space, the feedback wasn't that they didn't like the company. It was they wanted to see more proof points and come back later. Was quite a very common feedback that we had. And actually something we're taking on board now as we are planning out our Series B is going back to looking at all the feedback we received and taking learnings from what sort of are those the kind of valuation inflection points or value the sort of criteria that these later stage investors are looking for, so that we can time our Series B very effectively. Another point is really is around timing. So as you can see here in 2020, we took out essentially an advanced subscription agreement from our existing investors, so that we had enough runway for raising our Series A. And as you can probably tell, with COVID hitting, it did put the brakes on the venture market for a number of months. And it was really important that we'd actually taken out this bridge finance, because otherwise we may have run out of money last year whilst raising our Series A. So I'd recommend to anyone raising Series A to make sure that you have at least 12 months runway going into the process.
Just 1 minute, please, James. Thank you.
Yep. And then one final point would be, clearly, PICLO is a very mission-driven organization. It's focused around having impact, and profitability is part of the journey, so that we can have an even bigger impact. And so there are a lot of investors out there. What I would recommend is really understand what's really the motivation or the drivers behind those investors, and make sure that it's aligned with your companies, because they become part of your company. So that's the final sort of pearl of wisdom, I would say, is make sure you have aligned investors, which of course we're very happy with and very aligned with Clean Growth Fund.
James, thank you. Thank you very much indeed, and not least for sharing your personal life story about your business. I always find that intriguing about people that have remortgaged their homes or took out 10K to keep themselves paid to get things off the ground. I mean, we started 10 years ago ourselves as a minnow with a couple of people and just a few quid in the bank. So it's always heartening to hear your story. Thank you very much for that. Right, just conscious of time, so let's keep moving. And next up, we have Simon Blake from another of our founder members from Price Bailey. Simon's the partner in strategic corporate finance, and he's going to give us a few thoughts on how we can grow what is hopefully going to be post the pandemic. Simon, over to you.
Thank you very much. I will forgive me for a moment, my internet connection is not being great at the moment, so I hope it will survive. It failed halfway through James's session just then, so I managed to get it back just in time. I've got a couple of slides, but it's not important if they do fail, but let me put those up now. I guess from a Price Bailey perspective, we're one of the founder members of Cambridge Cleantech, and I'm delighted to be able to support Martin and the team over the last few years. We're a Cambridge-based firm of chartered accountants, and I run the corporate finance team, as Martin's mentioned. And our client base is across many sectors and includes a number of different.
I think we might have lost Simon again.
I think we did.
Clean tech opportunities, current projects that we're. Hi, can you hear me? I heard you say you lost me, which is really odd.
A little bit intermittent, but carry on, Simon. We'll persevere and we'll just see how we get on.
So as we think about the pandemic, I guess what we recognise is that there are both winners and losers. A number of businesses were completely closed for parts of the pandemic. Others were only partially open, and we need to be able to explain to our investors when seeking funding actually what was the true impact. But there are also plenty of opportunities that have been created by the pandemic as well, and we're seeing clients that are both winners as well as losers, I guess, from that. But at the same time, we're also seeing the impacts of Brexit happening, particularly around customer supply chains. And
I think we've lost you again, Simon.
and so we think it's really important at the moment.
Simon,
to the next world that we're living in.
What was your suggestion, Orianne?
I wouldn't say the new normal.
if you stop sharing the slides in your video, I'll share your slides. That should help a little bit.
Are you there, Simon? Simon, Orianne's suggesting that you turn off your video and your screen share, and she can show your slides and you can talk through them. Can you hear us? I think we might have lost Simon. Should we, I think what we'll do is we'll maybe come back to Simon because he's obviously struggling. I'm going to suggest that we go on to our next speaker, which is Talitha. From again, another of our founders from Goodwin Law. Talitha, can you step in and do your presentation now, and then we can maybe come back to Simon a little bit later.
Certainly. Good afternoon.
Thank you.
I'll just share the slides. Is that doing the trick? Is that all right? Yep.
Yes, yeah, thank you.
Fantastic. So yes, thank you for that introduction. As you mentioned, Goodwin is a firm of lawyers, corporate and commercial lawyers. And for the past 13 years, I've been assisting growing technology companies with their commercial legal agreements. That's working alongside my corporate colleagues who assist with the legal agreements for funding and equity investments and exits and the like. So following on from what James mentioned, actually, obviously raising investment and non-dilutive funding as well requires building that value in the company. And the commercial agreements the company enters into are key to building that value throughout its life cycle. Also following up on what James said in relation to investor due diligence and what they're looking for. One of the issues that investors are likely to be looking at is the intellectual property issues, the ownership by the company of its intellectual property, as well as freedom to operate in its space. And this comes, the commercial agreements that have been entered into come under scrutiny in this regard. So just touching on a couple of those commercial agreements. At an early stage, this is likely to be fairly simple commercial agreements, and most likely in the form of exchanging information and materials for evaluating potential future partnerships. Commonly, no money changes hands at this stage, and they can be seen as very simple, potentially unimportant agreements. But weaknesses in the agreements, even at this early stage, can be raised by investors in due diligence. And one of the things that investors may well be looking for is to ensure that the company has not become blocked by virtue of entering into even these early stage agreements. So if you're providing confidential information or proprietary materials to a partner, you want to adequately limit what they can do with your information and materials, and ideally ensure that you have the rights to use the results that they produce. Because at worst, if the other party owns those results, which they would do by virtue of being the one that produces them, and if they are patentable, unless the company has an express license back to those results, then any patent filed could block the company in some particular area. Obviously, that's a potential concern to an investor. Moving forward, building the value in the company is often likely to require some form of services agreements. At this stage, the company is ideally looking to own the results of the work coming out of those services agreements, which should be relatively straightforward if you're using an ordinary contract research organisation, if you like. It provides the service for a fee and grants exclusive ownership of the results. But it can be much more complex, especially entering into relationships with academic institutions, which, although highly valuable, necessarily usually involve granting the institution the right to publish the results and to use those results for their academic purposes. And it can also become quite complex if the other party is not a service provider, but in fact is looking to build their own value. And you can get in discussions around joint ownership of results and dividing up as between you who can do what with these results that are produced. And all of this is important to future investors who are looking to see two things really: that you have the adequate freedom to operate in the area that the company is operating in, but also looking to have some exclusive market position by virtue of ownership of the core intellectual property. Moving on further, looking at revenue generating partnerships. So as the company progresses further and has demonstrated the value of the technology, you can move into these revenue generating partnerships, such as joint development agreements or license agreements. And these have the potential to bring significant non-dilutive funding into the company in all sorts of forms: upfront fees, option fees, milestone fees, royalties, and the like. They also can be really valuable in that they have the potential to demonstrate the company's technology with a larger industry player. So that can make the company more attractive to yet further investors. But these larger industry players who can provide this funding are typically looking for a lot of the same things that investors are. That they're looking at all of the company's operations to date to ensure that the company has a clear ownership position on their core IP and also has the necessary rights to use other intellectual property that the company doesn't own. And this comes up in the warranties that are required in these types of agreements and the due diligence that will be done. So that's all from me. That's just a quick spin through the commercial relationships in the company's life cycle, and a pointer that the intellectual property management is really fundamental for this due diligence by investors.
Okay, Talitha, thank you very much, and indeed for keeping us to time. I think the lesson basically is that as you go through the life of your business, as we found out at Cambridge Cleantech, you're going to be entering partnerships all of the time of one sort or another. I think we got a very clear sort of timeline of the types of partnerships or contracts you may wish to raise with various other partners. And so obviously Talitha is available to advise on any of that, and of course some of that is then linked back to the potential for securing investment, because of course those investors are going to want to manage their risk and make sure that proper contracts and partnerships are in place before they do invest. So thank you very much for that, Talitha. Last but not least, we have Bryan Kay, who is looking at an alternative form of securing finance for your business through, I guess, through a sort of a leasing arrangement. If you're I'll let you talk about it, Bryan, but if you're a hardware company and you're looking to I don't know, sell lighting into Cleantech or sustainable lighting into a company, there are other ways of doing it rather than just the company paying direct. So I'm sure that Bryan will give a much better description of that than myself. So Bryan, over to yourself.
Many thanks, Martin. Let me just get this screen shared. Everyone see the screen okay?
Yes, thank you.
Yeah.
Excellent. Good afternoon, everyone. Thank you, Martin, for the introduction, and it's great to be involved today. As Martin alluded to, today I'm going to talk to you about a key area of growth for any business selling a product to increase the value of those sales by making it easier for customers to acquire the product that is being sold through reducing the upfront cost and spreading the payments. Type of finance is often known as point of sale or sales aid or vendor white label finance. Before I go into the product in detail, let me give you a quick background to ourselves. So Shire Leasing are one of the UK's largest independent SME funders. We have been around for 30 years, originally as a broker, but now with a large proportion of our finance done on our own book, which we control. We also have a business line from the British Business Bank, and as well as retaining that panel of around 40 specialist and mainstream funders. So very well capitalized business. What we do in a nutshell is, as I mentioned, spread the payments for a piece of technology or a vehicle or capital expenditure on machinery or equipment. We don't have enough time to go into the exact assets, but anything that's going to be used within a business, we can generally fund as a product. A good analogy would be if you took on a member of staff, it's very unlikely that you would give them their full 5 years salary up front on day one. Instead, you spread it as they provide the service, and it's exactly the same for a piece of machinery or equipment for your business. So we have around 66,000 customers in the UK. We're a significant player, and being well capitalised and at the forefront of those buying decisions also comes with a responsibility to be investing that in the right way. So a couple of just things to highlight what we're doing in terms of sustainability and environmental gains, and we're really leading our industry as best we can here. We're very committed to be, that's why we're here today talking to Cambridge Cleantech and involved in clean technology. We were instrumental in setting up the UK's first clean air zone financial assistance scheme, working with Bath Council on a framework for helping businesses to replace older highly polluting vehicles with cleaner, less emitting engines and hybrids for improving clean air, and that those cities have been mandated throughout the UK to make those improvements. The framework is fantastic in that it can be accessed by any council. So as well as setting up, we're also administering and active discussions with a number of other cities to roll that out, something that we're very proud of. We also are sustainability partners to Home in Manchester, who are a large community hub international arts organisation with significant membership locally and nationally as well, and we support as sustainability sponsors this year and next to help get the message out to businesses around changes around travel plans and environmental audits that Home provide, both to their members and also our customers in the area as well, to help them make better choices around the environment and their impact. And then finally, we also provide supplier finance to suppliers of clean technology and renewables, and this is what I'm going to talk to you in a bit more detail about now. We are currently revamping our onboarding policy and our underwriting policy to make it easier for accessing finance for these types of technologies. Really good recent example would be this business that approached us last year. They've created a very clever product that effectively takes empty bottles, which would otherwise be disposed of in the old-fashioned, thrown into a bin and collected by a big, heavy diesel polluting vehicle regularly. And instead of that model, this machine efficiently takes the glass and converts it to a fine sand, which is around 1/8 of the volume of the bottles. Much easier to store, much safer, and big environmental impact as well. So this business selling into hospitality and leisure at the moment with COVID, very, very difficult challenge. But to help overcome it and make it more affordable for their customers, they're all able to offer our finance product to reduce the upfront cost and spread the payment over 3, 4, 5 years, which makes it a much easier sell. Using technology, so we have an award-winning fintech platform which can be accessed on any device, allowing you to effectively provide our service at the point of sale in front of a customer, to quote and access credit underwriting approval and complete the deal with documentation. And the benefits to a supplier would be, generally sold over a period of time on lease. The end user is more likely to spend more. It's if the payments are able to be spread, upfront cost is reduced. It's easier to sell more product, and also the payment as well. The payment comes in far quicker. We take the risk on the end user, as long as they're happy to accept a term or commitment or payment. Then any sort of late payment or non-payment, we bear that burden, and you access the money up front as soon as the invoice is raised. So not only profitability that I've mentioned there, but also cash flow, which is crucial when growing a business, as I'm sure everyone will be aware. So that's a very high level summary of sales aid finance, not just for Cleantech, specific technology. We work across the board in sustainability. So please do reach out if you have any discussion around your product, your partners or customers, and whether you're using leasing at the moment or have done in the past, or be keen to find out more. I look forward to speaking to you in the breakout sessions, or do feel free to reach out to me direct on the details on screen. Thank you very much, and back over to you, Martin.
Bryan, thank you very much. So an alternative source of funding, you can sort of work with one of your customers or clients and see if they can be provided with the funding to enable them to purchase your product or service, basically. So thank you for that, Bryan. Now, I'm conscious of time running over a little bit due to some of the hiccups, but what I'm going to suggest we do is I'm going to go back to Simon in a second, because I think he's back with us just to finish off his presentation. Before that, just to remind you that we can then, I think what I'm going to suggest is we go straight into the breakout rooms, where those of you that have questions can share them directly with the other people in the breakout sessions. So room 1 is going to be Bev and Simon, who we're just about to hear from again. And then the other 3 speakers are in room 2, and then we've got open networking in room 3. So just drop a note on the chat box to Oriane if you want to go into one of those breakout groups. So Simon, are you back with us just to conclude your presentation?
I am, and if Oriane wants to put the slides up, well, that's probably better than me. And if you just go to the next slide, slide 4. I guess what I was trying to get to, and I apologise, my Wi-Fi died, is, as we focus on the future after the pandemic, have we updated our thinking in our business plans to reflect that? And we've seen many businesses that have had both positive and negative impacts from the pandemic. And any investor, therefore, looking at your business today is going to ask the question, okay, well, what has been the impact, particularly if you have got some historic financials that they have either going to look at or they are going to want to look at. It's also really important right now to update the cash flow projections that you have, because many businesses are seeing changes to their cash flow assumptions, whether that be pandemic related, whether it be Brexit related. I think a number of people and businesses are now really seeing delays in supply chain, for instance, or expectations of working capital being a different cycle to that of 18 months ago. And then turning to your investors, you need to just then be thinking about the investor aspirations. Have they changed? Those investors that you talk to, you might have had involvement with some time, may well have had a different perspective now in a post-pandemic world, either because they've got other investment opportunities they now want to back, or because actually they have seen changes in their own investor portfolio. And that, clicking on the next point, I think there's 2 final bullets. So that just can impact on both timing and possibly on the exit valuations that your investors might be looking for. And having an up-to-date conversation with your investors about what's realistic for your business and what's their aspirations. Because if those 2 things are not matching, then you've got trouble coming. On the other hand, there are many that are seeing opportunities for businesses that are thriving, perhaps with lower overheads or with greater revenue streams coming through from a post-pandemic world. So I guess my message is, don't just look at the business plan that you were working on pre-COVID. Make sure you are able to clearly demonstrate what the opportunities, particularly that are coming out of the pandemic, are on your business, and how that is going to help build your business and lead to the investors' exits, because most of our investors are ultimately really interested in an exit event. They will be interested in the business itself, but they're also interested in what they will get from it and when. So I think my summary really is, make sure you understand what the pandemic has really done to your business, and make sure you can demonstrate that and answer that clearly in your business plan, because any accounts, any financial models you wrote a year ago are probably completely out of date, and an investor is looking forward, not backwards. So make sure they see the opportunity for the future and don't get bogged down with trying to explain funny, odd accounts that have got all kinds of different things going in there from related to the pandemic. If you have got extra debt or burdens because you had to furlough staff, you had to take on, or you took the opportunity of taking on extra debt that was easily available during the pandemic, well, just properly think through how you're going to unwind that situation. There are many people that took the extra funding out from the CBILS or bounce back schemes, or even the future fund schemes, that actually haven't necessarily needed it in quite the way that they thought, and others that have needed it and need more and might be looking for the recovery loan scheme now as well. But update the plan, be real about it, and show your investors what the opportunities and threats are going forward. Thank you, Martin.
Okay, thank you, Simon, for concluding your presentation. I'm glad we got you back, because there's some salient points there about what to do. I mean, I'm going to hand over to Oriane in a minute just to tell everybody how we move into the breakout rooms. But I think that was yeah, very useful. I mean, from our own point of view, last March, 18 months ago or so, we very quickly sat down and did our emergency plan. What happens if no more money comes in from tomorrow? You know, worst case scenario. And I then did that monthly on an ongoing, have been doing so on an ongoing basis because of the changes and disruption due to the impact of the pandemic. And I've spoken to other Cleantech companies who've been doing this weekly. I thought I was being zealous, but it's yeah, you have to watch those. You have to watch the cash flow and the income and outgoings as well. So thank you very much, Simon, for that. So Oriane, over to you. Do you want just to explain everybody how we get into the 3 breakout rooms?
Hi everyone, thank you for joining us. So Well, when you registered for LinkedIn, you selected one of the breakout rooms, or you've updated it with my colleague Cynthia. So we've acknowledged that, and we put you into 2 different rooms. The first room is Bev and Simon. The second room is Talitha, James, and Bryan. So what I'll do now is I'll open the rooms, and if you just click on the link, it will lead you to the room, and we'll be joining you and checking that you're happy with the room.
Thank you.